Good morning, ladies and gentlemen. It's Butch Shorrock, Options University, Monday, October 8th, 2012. Access to this video is for informational and educational purposes only. Nothing contained in this video, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Options University provides educational services that are meant to teach you the risks and rewards of trading stocks and options, and we're not a service that tells you what to trade. We're not implying or guaranteeing any profit, and as always, do not trade with money that you cannot afford to lose. And we just had quite a week in the market, and quite a week in our economy, and quite a week in our country as we saw the first of the debates take place between Obama and Romney, and what we are a very crucial point in our entire economy and in your stock market future. It is very important that you know how to make money both to the upside and the downside, and to take advantage of those things called technical analysis, which gives us our edge in the market. As we saw during the last week, we had plenty of economic news. We had PMI manufacturing on Monday. We had ISM. We had the construction spending. Motor vehicle sales took place on Tuesday. ADP employment report. ISM non-manufacturing index came on Wednesday. Thursday we had a nice surprise, and we had jobless claims, and it was good to see that the jobless claims actually came out better than expectations. And then finally we get to the big one, which took place on Friday, and that was the employment situation, which came out at 8:30 before the market opened on Friday morning. Employment data really got everybody buzzing quite clearly, and you saw lots of news in the media about it. And the data was a bit confusing, causing people that certainly have established themselves as experts in the field of business to question its accuracy. Even Jack Welch, the former CEO of GE, came out and said some kind of wild things about Obama influencing the department and getting us false numbers. And so it's kind of interesting because certainly things like that can happen, but when we look on it, we saw we had an unexpected drop to 7.8% when we really were expecting about 8.2%. So this is the first decline below 8% since Obama was inaugurated. And of course, the scream was, how could this possibly be taking place when we really don't see it in the economy? And it turns out that there are a couple of different ways that the survey is done, and one of them is done with a household survey where they call certain households and they find out what the employment numbers are. And the unemployment rate reflected an 873,000 spike in household improvement versus a 368,000 drop in August. And so how could we account for this? I mean, if we look at all these people suddenly having jobs, we would expect a GDP going up by 9 or 10% or so. And, my goodness, we know that that's not the case. So how could this possibly happen? Well, over 600,000 now hold part-time jobs, assumed to be a result of them falling off of benefits and needing to work out of necessity. So what are they working? They're working part-time jobs, and this is what comes out. And this may have been in what the surveys came out. So you get a couple of different surveys, and one survey is done by contacting households over the phone, and that's done with 50,000 households. And the other way the surveys are done are to actually talk to the employers, and they gave us totally different numbers. And so what we saw was basically the largest monthly increase in the household survey, where they called the houses, and it was the largest we've seen in 29 years. And so if you actually read the study, you'll see that part-time jobs for economic reasons rose 582,000 in September. Yes, that's correct. Part-time jobs. Why? Because people simply have to work. And put simply, 67% of the new jobs, of the 800 and some thousand jobs reported, were with the household survey, were part-time jobs because full-time jobs just plain aren't available. So that explains why we got that big number with employment situation where it dropped down to 7.8%. So is it a true statistic? Well, it's a true statistic according to take the survey that way, but is it a meaningful statistic? Well, the economy isn't growing at any great leaps and bounds at this point, and you certainly can see that if you look at the economy and speak to the companies. So it's interesting that this would come up at this point on the political side, but it is what it is, and so that was part of what caused our rally on Friday, looking at those big numbers and the big clamor by so many people to say, what kind of nonsense is this? How could we have the largest increase in 29 years? Quite a week in the market. And now we come into this current week where we'll be talking about earnings, where we focus on that. Monday has no economic announcements whatsoever. Tuesday doesn't have much showing up. Wholesale trade comes out on Wednesday. Probably won't move the market. Beige book probably no longer moves the market. Going into jobless claims Thursday morning at 8:30. Import and export prices at 8:30 before the market opens. And then Friday, we have a couple of far more interesting economic announcements. That's the PPI and the consumer sentiment, both of which have been known to move the markets. On the after the market on the 9th, right here, we will see Alcoa begin what many consider the real beginning of earnings season, as they announce after the bell Tuesday the 9th. So with that, let's take a look at last week and what happened on Friday. Taking a look on Friday, we see that we had what could be or what might be a topping type signal. As we see, we got a doji out of the SPX. Notice we continue in an upward trend. We spend our time still above this 30-day moving average, and notice that we went up and hit the top of the Bollinger Band. So while we seem to be moving higher, we'll have to see whether we're going to reverse on this kind of news. What trend are we in? We're in an up cycle, getting higher highs, higher lows in a uptrending market with the potential for some kind of reversal and maybe have a pivot here and start heading back down to that moving average as we go through normal market cycles. No real reason to think we're going to have a big pullback, and it looks like we've kind of gotten through that. But earnings will have an influence on where we go in this coming quarter. A fourth quarter of the year is usually the strongest quarter. However, we've had quite a run in the market for the last basically 6, 7, 8 months, and there is some question whether we can keep going at this pace. We do have an election going on, has an influence on the market. Earnings have been all basically downgraded, so we may be able to hit expectations. It'll be an interesting fourth quarter, and we'll see if we follow our normal trend of uptrending earnings and uptrending market because of the earnings announcements. All right, next let's take a look at a little tighter looking at the last 5 days, and we see that during the last 5 days what we got was higher highs, higher lows, and then Friday ended up with this doji. Expectations are we may see a rollover as we've basically gone up and hit our horizontal and our diagonal resistance points. So we might see a pullback as we get these normal cycles. Notice these pullbacks take place a whole lot faster, but we just had one of these. Notice how it only took 3 days to go down, and it took 1, 2, 3, 4, 5, 6, 7, 8 days to return back to the same level. So that's how we see the market move, much faster to the downside than the upside, and we might be ready for a little bit of a downward cycle in this uptrending market, as it will provide for us opportunities to get in at a lower price. Next, let's take a look at the Dow and see how the Dow compared with the SPX. Notice the SPX basically got up to previous highs. Let's see if the Dow followed in that same manner. And as we see, looking at our yellow area, here's our previous high sitting over here, and here we are with the high this week. So we are at a point of resistance. Next resistance above us will be going for all-time highs, so at least highs for the last 5 years. So an interesting time to see whether we're going to pop up during this next quarter. And there are those that'll tell you that we're ready for the next bull market. And if you think about it, we've had quite a long-term pullback and a bit of a secular bear market, and if we can come out of this recession and come across the entire world, we could be time for another bull market. Don't be surprised if we have a bit of a pullback in this fourth quarter. Remember, we're going to trade what we see, not what we think, and it is a time where we'll definitely have to respond to what the market's doing. Looking at the NASDAQ, we see Apple sold off this week, and of course it's hard for the tech sector to run when we don't see Apple running. So this was our previous high on NASDAQ, and the NASDAQ was relatively weaker than the S&P, as we didn't see it rise to that next high level. So we're off the 30-day moving average, but did not follow through as the S&P and the Dow did. Next, take a look at the Russell, see what the Russell did. Our same situation. There's our previous high, and basically we are having trouble breaking out. And so what we see coming out of this is we see this triangle, and it's going to break out one way or the other, and so keep your eyes on the Russell to give you a hint of where this overall market may be going, because many times the Russell will give us a 24-hour lead on where the rest of the market is going. So watch that Russell 2000 carefully as to any kind of hint as to what may be happening here in the fourth quarter with earnings. So that it can be a precursor, so watch it. Next, taking a look at the indexes for the week, we saw we had a couple weeks of negative numbers. Notice what we have all this week. Everything is in positive numbers as we went into that nice little up cycle. And we see the Dow up 1.3% for the week, NASDAQ up 0.6%, S&P up 1.4%. Everything sitting up there in double digits, with the NASDAQ, which is not at its previous high, gave us its highest year to date, up 20% out of the NASDAQ. Look at the S&P, up 16%. So quite a year for the NASDAQ from where it started. So nice moves in the indexes this year as we've had this consistent rally taking place from early summer. All right, next, taking a look at the VIX, you see that when we look at the VIX and we look at this period of a couple years, it's kind of interesting. We're down in this area down here. We can call this the no fear. There's not much fear down here. And so volatility is a little lower on some of our options. We're okay with that, but we're just kind of sitting in that no fear, no great panic in the market as we see the VIX staying below that 20 area, which we call our no fear zone. Of course, this area up here, this yellow area, this is our fear zone. Where we get our VIX from is it's basically calculated on the level of put option activity over a 30-day period. If you see a lot of buying of puts, it tells you that that is basically a protection for portfolios, and it causes the index to rise. So we're not seeing this. As we look down at the VIX, we see it's extremely low, on the low side for the last 2 years. So that kind of gives us an idea of what the VIX tells us and why we're interested in this fear index. Looking at a little larger picture of it, you see that we really are at the lows of that. So now, the air is probably getting a little thin up here on the indexes. When we see the VIX get this low, it's usually time where we have that down cycle. So we saw the SPX going up. We saw our Doji on Friday, and we very well could see a little bit of a pullback as we go into this week and into earnings. Pullback back to that 30-day moving average, probably not quite yet a change in trend, unless we see some horrible numbers come out of earnings, which, basically the corporations try to protect themselves against. Notice as the bonds are pulling back again, and the bonds are not showing the previous strength, trading in this downward cycle. And remember, we talked about this early in the week when we met last Monday, and I said watch for a sell signal on the bonds as it was sitting up against resistance in this what we would call diagonal channel, trading between the different levels of the diagonals we have drawn there. Bonds, as indicated by TLT, our ETF on bonds, in a downtrend, in a down cycle. Next, let's take a look at the financials, and we see that the financials have certainly been leading the market up. Did not quite reach the same level, but had a pretty good day on some of the week as it just kept going up, 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 and up. And then Friday we basically had a little bit of a pullback in the financials as we saw the market sell off. Going into the close, the financials followed that same pattern. So XLF, our ETF for the financials, certainly may be providing us an opportunity. Watch if the overall market pulls back. You will see the financials pull back at least to our moving average. So opportunity in the financials this week if we see the market pull back. Watch Alcoa, it will give you a real indication of what's going on. Watch the Russell, may give you a leading indicator as to what's going on. Next, let's take a look at oil and see what oil has done for us during the past week. And we see that it basically has been consolidating at this lower level, and it really is not near what were its previous highs. Kind of interesting is that crude oil prices did go down a bit on Friday after a big day on Thursday. But if you go to the gasoline pumps in Southern California, the prices are still $5 a gallon out there. So they still manage to get money out during prime travel time in California, don't they? Next, let's take a look at our ETF for gold, GLD, and see what gold did during this week. And we see that gold near a high as we're approaching that $1,800 an ounce level for gold. So gold just keeps right on running up, that flight to safety where people feel that they may have a safe haven there in case of that cliffhanger that we keep hearing about in the media. All right, and finally, let's take a look at Friday and see what kind of volume we had in the overall market. And we see that we're up in the SPY, our ETF for the S&P 500. We see that we're very near to that upward level of the SPY, and we see that we're doing it on basically what has been average volume for the last few months. So no big volume surge as we hit that what could be a top in the spider. So tells us what happened to us during the last week. Average volume, market in an up cycle, giving us a potential reversal signal, but remember, it's not a reversal signal for the short term until we get confirmation. Confirmation would be lower lows and lower highs. So with that thought, we've taken a look at our indexes, taken a look at a couple of our favorite sectors, and we see that the market's just clicking along. We're going into the week with earnings beginning Tuesday night with Alcoa after the market closes, and we have a decent explanation on what happened to those employment numbers suddenly to drop down to 7.8% for the biggest move in the last 29 years, which you and I don't see in the economy. So at least we understand how those numbers came to pass and what's taken place. For those of you that are gold members, stick around. We've got our stocks to watch, see what they did during the last week. And so with that thought, if you'd like to see more free videos from Options University, go to www.optionsuniversity.com/free gold. This is Butch Shorak, Options University. It's Monday, October 8th, 2012. Thank you for being here.